More than a week after the cold card debacle, security vulnerabilities continue to be discovered in Bitcoin-related products, as aftershocks continue to ripple through the Bitcoin community. Despite all of that, however, Bitcoin price has remained remarkably resilient, and important Bitcoin adoption continues. We get into all of that and more on today's episode of the Bitcoin Bulletin Podcast.
This podcast is for information and entertainment purposes only. Nothing on this podcast should be construed as financial advice. All views expressed on this podcast are solely the opinions of the host and/or any guests that we might have from time to time. Nothing on this podcast should be construed as a specific inducement to make a particular investment or to follow a particular investing strategy.
Guten Tag, buenos dias, morgen, and welcome to episode 281 of the Bitcoin Bulletin Podcast. I am your host, Chris, and this week I'm coming to you from an undisclosed location on the high desert of New Mexico. As I mentioned last week, I'm going to be on the road quite a bit this month, and as such, I'm going to try and keep this episode tight. So far, this road trip has taken me across 8 states, and while it's been a little whirlwind, I did get to spend time in some places like Memphis, Tennessee, Amarillo, Texas, and Tucumcari, New Mexico. Because I'm on the road, though, there's a couple of things. First of all, the timing of the upcoming episodes might be shifted a little bit. We'll still do our weekly DC episode exactly on time, our weekly DCA stack exactly on time, but there may be a delay in the episode coming out. I'm also traveling with a travel microphone and my dog, who's sitting right here next to me on the floor, behaving really well. So that's cool, but hopefully that stays that way. So if things sound a little bit less professional this episode, I do apologize. But we're having fun out here currently in New Mexico. And speaking of which, I'm going to be in the Albuquerque, Santa Fe, and Los Alamos, New Mexico areas in the next week. And if you're listening from out west out here, or know of any meetups or any Bitcoin activities going on, or any businesses that are on a Bitcoin standard that I just absolutely have to visit and spend some of my Satoshis at, drop me a DM on X, where we are at BTC Bulletin Pod, or send me an email. We are bitcoinbulletin@protonmail.com for the email address, because I'd really like to see what's going on in the Bitcoin space out here in the land of enchantment. All right, as usual, there's a lot to talk about today, and I have a little bit less time than usual to do so. And of course, we do have our weekly DCA segment as well. But before we dive in, let's take a moment for our customary look at Bitcoin's vital statistics. At the time of this recording, we were sitting at block height 962,199. I've mentioned numerous times that the number 962 is a special number to me. Maybe one day I'll get into that in a little more detail. So pretty cool. We're at block 962,000 as we're closing in on the 1 millionth block. So probably about 38 weeks. So less than a year away from block 1 million. And that's pretty cool. I mean, that's a significant milestone, right? Bitcoin's current price is bringing in a little bit lower than last week, but still in that range of the $63,000, $64,000 range that we've been at for more than a month, 2 months actually. Going back all the way to June. Bitcoin's current price is $63,470 US, so right about $1,000 less than last DCA Wednesday. And that means we're going to get about 30 sats per dollar more. So when we stack $20 of the Bitcoin later in the show, that means we're going to get almost 600 more Satoshis than we got the week before. So that is the thing I like the most about seeing that price go down a little bit. It's scary watching those Bitcoin crashes, even after having been through many cycles. But, if you're a Bitcoiner and you're here for more than just number go up, if you're not trying to get rich quick, you should be excited that Bitcoin is under the previous all-time high. That Bitcoin is under 100,000 US dollars, because it's going back. As Adam Meister always says, we're just one day closer to the next all-time high. Sooner rather than later. I mean, it's hard to believe that we're more than halfway through 2026 already, right? I mean, it seemed like 2020 was the year that was never going to end. And then it, seemed like the halving was off in the future. Then we had the 2024 halving, but it seemed like the new all-time high, which is usually 12 months to 18 months after the all-time high, was never going to happen. And then, here we are. And 2026 is already halfway over. We're less than 2 years away from the next halving. So Bitcoin marches on, TikTok next block, regardless of what we're obsessing on a day-to-day basis. But I'm happy that we're going to be able to stack 1,576 Satoshis for every US dollar that we convert into Bitcoin today. Bitcoin's current price means it has a market cap of 1.27 trillion US dollars, still more than a quarter trillion higher than that $1 trillion number. That is kind of a magic number. That means Bitcoin is in, that asset class of the largest assets in the world. And that's pretty exciting. For those of you who still value your wealth in shiny yellow rocks, it will currently cost you 15.1 ounces of gold to purchase just one Bitcoin. And for those of you who value wealth in something a little yummier than trying to eat metal for lunch, one Bitcoin will currently purchase you 3,549 large pepperoni pizzas from Papa John's. That would be one pizza every day for almost 10 years. We follow that metric here on the Bitcoin Bulletin Podcast because it's kind of fun, and as an homage to the very first real-world transaction made with Bitcoin back in May of 2010, when Laszlo Hanya made the purchase of 2 Papa John's pizzas for that staggering sum of 10,000 Bitcoin. Plebs, that was 16 years ago, but when I first started doing this podcast, it was only 10 years ago. So it's just an example of time marches on. That metric that has been my absolute favorite metric to follow the entire history of this podcast. I'm a little distracted right now because my dog is trying to shred the carpet in the guest bedroom of the house I'm staying in tonight, where I'm doing my podcast. So if you heard a scraping noise a minute ago, followed by chain rattling as I kind of nudged her with my foot and said, please knock that off, I apologize. And most importantly, I apologize because it's distracting from my attention going over these statistics. But getting back to those stats, Bitcoin's 24-hour average transaction rate is doing quite well, coming in at a blazing 6.55 on-chain transactions per second, roughly where we were last DCA Wednesday. And remember, we've been doing this podcast for going on 6 years now. And during the original years of this podcast, anytime we saw more than 3 to 3.15 or 3.25 transactions per second, that was usually indicative of really, really healthy Bitcoin adoption. And right now, we've been sitting above 5 or 6 transactions per second for months, years really, with the exception of a couple of oddball one-off weekends. And that's really cool, especially considering when we first started doing this podcast, Lightning wasn't really a thing yet. And now a significant amount of activity takes place on the Lightning Network. I wouldn't use an on-chain transaction to buy a cup of coffee. And if you're buying that steak burger and tallow fries at Steak and Shake, for example, they only accept Lightning. And when I buy my coffee from El Salvador, from Good Beans in El Salvador, I pay with Lightning. And none of those reflect in this metric. So pretty exciting that we are higher, double the transaction volume we were when we first started this podcast. And that doesn't even include Lightning. That is bullish, incredibly bullish. Speaking of that on-chain activity, the mempools are a little clearer than they were last DCA Wednesday. Clark Moody's dashboard is showing just 573 transactions pending in their mempool, despite the fact that the last block took just about 20 minutes. So more than double the time it should have taken. And we still have less than blocks with the transactions pending. So those blocks are clearing as Satoshi intended, and that's really cool. Mempool.space runs a much more liberal mempool. And even they are showing 8,000 fewer transactions than they showed last week, with just 82,893 transactions in their mostly spam mempool. And if you're wondering why I'm calling it a mostly spam mempool, I go into that in much more detail many episodes back. But the long and the short of it, if you're a first-time listener, is that Clark Moody runs, well, first of all, he runs a mempool with a much smaller mempool size, so it'll only accept a certain amount of data in the mempool, but it also has the traditional default of excluding any transactions that don't pay at least 1 Satoshi per VByte as a mining fee, whereas mempool.space includes fees as low as 0.1 Sat per VByte, and that's mostly those spam transactions. So hence the difference in mempool size. If you're trying to consolidate Bitcoin, if you were trying to move your Bitcoin off a cold card, or if you have a big important purchase that has to be done on chain, though, The good news is you're most likely going to be able to get in the next block because there's less than one block worth of transactions pending. Actual, transactions with a more than 1 sat per VByte fee, an actual monetary transaction. Despite all that robust on-chain activity, because of the relatively full mempools, it's still relatively cheap to send an on-chain transaction. I've got a little bit of conflicting data from the two different sources I'm looking at. Again, Clark Moody's dashboard, even though they're showing a completely clear mempool, is recommending a fee of 4 Satoshis per VByte for a high priority transaction, saying that a lesser priority transaction can include that 1 sat per VByte fee. Again, I think that's tainted a little bit from the fact that we've seen a couple of blocks come in that took 20 or 30 minutes in the last hour. So I would expect that 1 sat per VByte fees would clear in the next block relatively regularly nonetheless. And of course, mempool.space agrees. They're saying a high priority transaction only needs a 1 sat per VByte fee. Although if you are sending a spam transaction, you want to roll your own or whatever, they're saying that a fee of as little as 0.2 sats per VByte will be eventually mined. But plebs, 1 sat per VByte, given the size of the average on-chain transaction multiplied by the current price of Bitcoin, that works out to just 10 cents, which is really insane to think that you can be your own bank. You can wield unstoppable, uncensorable, sovereign, independent power for as little as just 10 cents for a high priority transaction. And that is also bullish. Since the last Bitcoin Bulletin podcast, we've had a difficulty adjustment in the difficulty it takes to mine a block of Bitcoin. Bitcoin adjusts its difficulty every 2016 blocks, which theoretically works out to once every 2 weeks, with the goal of maintaining a block time of once every 10 minutes on average. And when those blocks are coming in too slow, it relaxes the difficulty. That's when we get those occasional difficulty decreases. And when blocks are coming in too fast, which is usually the case because like the price of Bitcoin, if you zoom out, it goes up and to the right. Same thing with the amount of computing power securing the network, it goes up and to the right, and hence difficulty goes up and to the right. We are now 1,449 blocks away from the next mining difficulty adjustment, so less than halfway there, about 10 days to go, sometime around August 22nd is estimated. And it's looking like it's going to be, well, as it stands, it's looking like it's going to be a difficulty decrease. It's really hard to tell because, even if difficulty were set exactly perfectly, it really comes down to random chance. So, if you were going to flip a coin 2,000 times, you'd get roughly 1,000 heads and 1,000 tails, but the first 4 flips might all come up heads. Just like the first few blocks might all come in faster or slower than they will for the remainder of this difficulty epoch. So I wouldn't put much creed in this estimate, but currently it's looking like on August 22nd, we're going to see a difficulty decrease of as much as 3.4%. And that is because in the first few blocks of this difficulty epoch, blocks have been averaging 10 minutes and 26 seconds, which is obviously slower than once every 10 minutes. All right, on to the news. For a lot of people, there's a couple of news stories that I'm not even going to really get into. There's that BIP 110 thing, which is over and done with. It's ancient history, so we don't even need to talk about it, regardless of whether you were pro or against BIP 110. A lot of people are still in a panic about the cold card debacle. We will get into that. But what most normies are talking about is inflation. It's CPI, it's the war in Iran, etc. And with all the talking heads predicting a huge spike in inflation because of the Iran war and, the on-again, off-again closure of the Strait of Hormuz, many people were predicting that we might even see an interest rate hike as soon as September. However, there were those, including Lawrence Lepard, who were saying that there was just no chance we'd see an interest rate hike and that we would see interest rates come down sooner rather than later because the government needs lower interest rates to be able to pay off its debt or have any hope of paying off its debt. And that, as he coined it, there's a massive, with a big print imminent. And of course, I often remind you that government statistics, especially CPI, are heavily manipulated numbers that usually don't reflect reality anyway. I mean, if you go out and buy a hamburger, the price of your fast food meal has basically doubled in the last couple of years, even though we haven't seen anywhere near that kind of inflation officially. And so as Mark Twain eloquently put it, there are 3 types of lies. lies, damn lies, and statistics. And CPI is probably the worst of those stats. But with all of that said, the official inflation numbers for July were released today, and magically they came in lower. As of July 2026, the annual inflation rate is officially 3.4%, which is still elevated over the target 2%, which is inexcusable anyway, because the idea that your money should get 2% less valuable every year is horrible to begin with. It's one of the reasons we're Bitcoiners, but 3.4% was a slight decrease from June's 3.5%. So that means officially, according to the government numbers, inflation is cooling. And the so-called core inflation, which strips out the price of food and energy because of how quote-unquote volatile they are, not that you could survive without buying groceries or gasoline, but the core inflation measurement came in even lower at 2.5%. So there you have it. The inflation boogeyman is officially off the table, at least for the time being, giving the Fed cover to potentially resume rate cuts. Or at least this should quell the speculation of an imminent rate hike, and markets and Bitcoin included should generally react positive to that. Of course, last week we covered the cold card entropy bug and some of the fallout that had already happened. But since then, everybody has been using AI basically to audit their code to try and find vulnerabilities before the bad guys do. And as such, several more vulnerabilities have been discovered, including BTC Pay Server. Now, this probably doesn't affect most plebs, but if you are a small business owner and you're accepting Bitcoin at your business, this might very well affect you. So if you are running a BTC Pay Server, this is particularly insidious because it's not as simple as just hitting upgrade or even deleting it, saying, I'm not going to use BTC Pay Server anymore and deleting the app. That won't protect you. You have to actually take some additional steps to make sure you don't get your Bitcoin stolen. These steps are outlined. BTC Pay Server has an official guide, but depending on how you're running BTC Pay Server, tongue twister there. But for example, if you're running BTC Pay Server on an Umbrel, there are Umbrel specific instructions that are listed on the Umbrel app page in the Umbrel app store. But basically what it involves is manually deleting your Lightning node credentials and then letting your Lightning node assign new ones so that an attacker that might already have your credentials can't hijack your node and steal your funds. And this sounds like a massive pain in the ass, and it kind of is, but it's not as bad as it sounds, even for those of you who aren't necessarily super technical, like a lot of us Umbrel users probably are. And, it is. So I just wanted to point out that it's a bit more complicated than just updating your app, but it's not the end of the world. But if you are running, well, especially on an Umbrel, it was just a matter of going into the file. It was a matter of just shutting down Umbrel and shutting down your Lightning node, and then you clicking stop, not in Umbrel, and then going into the file server and deleting a couple files, and then turning those apps back on and letting them produce new credentials. Of course, that means that you're going to have trouble accessing your Lightning node unless you update your Lightning apps like Zeus, for example, because your credentials will change. But this hopefully doesn't affect too many of you. But if you are running a BTC Pay Server, this is a big one. Make sure you get on that immediately. And of course, just hours ago, another important security upgrade was released by Electrum with Electrum tweeting, "New release, Electrum 4.8.1, please upgrade." This release contains important security fixes, release notes, and binaries. So if you're running Electrum, make sure you do that upgrade. And that looks like it's just a matter of upgrading upgrading your app. Nothing is odious or onerous. Odious. Nothing as technical as fixing the BTC Pay Server exploit. I'm hovering over my portable USB microphone here, and I'm consciously trying not to point my mouth directly at the mic because this one doesn't have a pop guard, a plosive guard. So if I'm getting any loud pops in this, I'm sorry. Hopefully I'll have a better setup next Wednesday. I did do a whole bunch of audio checks, recorded a couple practice segments before this podcast, so I'm aware of the limitations of this microphone, and I'm trying my best to sit in exactly the right position so I can get the best sound quality possible. But my dog is sitting right behind me, chewing away on a bully stick rather loudly, and so If I change my position and blow your ears out with a pop plosive, I do apologize. So getting back to the cold card for a moment. It was now estimated that $1.5 billion of the Bitcoin had been safely moved off of cold cards following the exploit. And that is actually really incredible for a couple of reasons. First, it shows just how much worse this attack could have been. 100 something million dollars of the Bitcoin was stolen, but it could have been another 1.5 billion. But it also shows the significance of the community response. The word got out, people did what they needed to do, and safely moved $1.5 billion of the Bitcoin off of their cold cards. And the fact that we're talking about plebs here shows just how significant that is. Because if we were talking about, a bigwig moving 1.5 billion, that's no big deal. That happens often. But that happens in one transaction. What we knew about the cold card hack is that most of the people that were losing their money had small wallet balances, a quarter of a Bitcoin, a tenth of a Bitcoin, or even less. So we're talking about many, many, many individual transactions to add up to $1.5 billion of the Bitcoin. And the fact that it did that without the network fees, for example, jacking through the roof, was pretty important. And I think this was actually a pretty significant real-world stress test that the Bitcoin network passed with flying colors. So pretty cool. Hopefully the worst of that is behind us and we don't have to deal with another black swan like that for quite some time. Speaking of bigwigs, last week, we mentioned that Michael Saylor's strategy had pivoted away from their 5 weeks of not purchasing any Bitcoin to actually dumping Bitcoin, selling 1,638 Bitcoin. Well, this week they did it again. Strategy sold another 1,690 Bitcoin. I do want to point out that didn't take the price either, so that's pretty cool. Of course, they used the proceeds to shore up their yield product, repurchasing 1.15 million shares of their stretch product, with Saylor tweeting on Monday, Strategy has increased its USD reserve by 650 million and repurchased 109 million of stretch. This increased USD duration by 143 days and at 2.7 years, by 173 days to 2.7 years, and tightened Stretch's BTC credit by 10 bips. As of 8/9/2026, we hodl 840,447 BTC in our BTC reserve and 4.56 billion in our USD reserve. So hopefully that's enough Bitcoin selling for Strategy. But even if they continue, it's good to note that they can dump 1,600 some odd Bitcoin 2 weeks in a row. And here we are still holding in the $64,000 range. So last cycle, I guarantee somebody dumping 1,600 Bitcoin would have significantly tanked the price. So while Michael Saylor's strategy is dumping, the Bitcoin ETFs quietly had a really strong inflow week last week, with the Bitcoin spot ETFs seeing $853.5 million in inflows in the week ending August 7th. So despite the fact that Saylor is taking a break and even selling off some of the Bitcoin, other institutional and financial normie accumulation continues. And speaking of Bitcoin treasury companies, European corporate Bitcoin adoption made a big change, with H100 jumping to the number 2 position on the Bitcoin treasury list. H100 Group is a Sweden-listed Bitcoin treasury company, and apparently they obtained a few Norwegian Bitcoin companies that were holding 2,455 Bitcoin collectively, which pushed H100's total holdings to 3,506 Bitcoin, making it Europe's second largest publicly traded Bitcoin treasury company. So that's pretty cool. While Saylor's off selling, other Bitcoin companies are still buying, or at least consolidating, maybe showing that the Bitcoin treasury market is not collapsing, but maturing. And more bullish news, another state pension plan has gotten on the Bitcoin bandwagon, or at least the Bitcoin exposure bandwagon. The Alaska Retirement System has announced that it has purchased 19,804 shares of Strive. Strive being a Bitcoin yield product, but indirect exposure to Bitcoin. And so that's important to the Bitcoin space. It would have been better to see them buy actual Bitcoin, or even the Bitcoin ETFs, where they're allegedly holding, paper Bitcoin at least. But The fact that they're dipping their toes in Bitcoin-related products is a sign that, despite the fact we're in the bear market here, despite the fact that we're hopefully near the cycle low, institutional adoption, or in this case, public adoption, is continuing. And 19,804 shares of Strive is a pretty significant chunk of money for them to dip their toes in. So good for the Alaska retirement system. But guys, hopefully you'll actually just buy the underlying asset. I mean, I can understand why, a quote unquote guaranteed yield is more appealing than having to report back to your stakeholders why your asset value, your holding value goes up and then down with the volatility of Bitcoin, even though if they just zoom out and you say zoom out and look that Bitcoin's going up and to the right, but when you're talking about, employees looking at whether or not they're going to be able to retire, most of them not being Bitcoiners, most of them not understanding cycles, et cetera, it's definitely a lot more politically palatable. Gesundheit to my dog, who's now sneezing directly behind me. All right, one last bit of fallout from the cold card debacle. Apparently, Matt Odell is ducking out of the limelight for a while. He tweeted 2 days ago, taking time off from podcasts, social media to reflect and figure out priorities. And then there's a sponsor disclosure that I haven't been able to independently verify, but that's been circulating on X. And whether it's authentic or not, what it says has already been basically confirmed by Odell on Twitter and Nostr. But it says sponsor disclosure. Both of my podcasts are paused indefinitely as of August 3rd, 2026. Rabbit Hole Recap was sponsored by Strike, CoinKite, Stackwork, and Salt of the Earth. Citadel Dispatch is a free and open project that is 100% audience funded. It is never and will never have ads or sponsors. I think it goes a little bit beyond having CoinKite as a sponsor. I think Matt and Marty's venture fund capital was actually an investor in CoinKite, so they're definitely feeling the sting. And whether this was lawyers saying, hey, you guys just need to shut up for a while because we don't know what's coming down the road, what's coming down the pike as far as lawsuits are concerned. Because it's likely that CoinKite will just disappear, and then good luck getting any money out of them. But so then the attorneys do what attorneys do best, and they look for other sources to go after. And it would not be beyond the realm of possibility to imagine them going after people who were paid to promote those products, paid to promote cold cards. So who knows what the case is, and hopefully he gets over it, because I was really looking forward to listening to Rabbit Hole Recap tomorrow. All right, time to move on to our weekly DCA segment. What is DCA, you might ask? Well, DCA is short for dollar cost averaging. And dollar cost averaging is an investment strategy where you invest your money in equal portions at regular intervals, regardless of price. For example, completely ignoring price, we set our equal portion at just 20 humble US dollars, and we chose weekly for our regular interval. Of course, these are both you do you things, but we chose just 20 US dollars for a couple of reasons. I wanted to show that even if you were of very humble means and $20 is all you can manage to scrape up every week to save for your future, that eventually that would add up to an appreciable stack of Satoshis that would put you in the new financial elite one day when we do achieve hyper-Bitcoinization. And of course, I chose weekly because not only is that a really common interval for people doing any type of dollar cost averaging, because usually you invest when you get your paycheck if you're a normie with a fiat mining job, but it also worked out really well for a weekly Bitcoin podcast. Again, these are both you do you things, but we chose $20 a week, and so far we've been very happy with those results. Today will mark our 264th weekly DCA episode. We began our weekly DCA series all the way back on July 28th, 2021, so more than 5 years ago, 263 Wednesdays, in fact. And since then, we have stacked every Wednesday, converting a total of 5,260 US dollars into 12,159,987 Satoshis. There are 100 million Satoshis in every Bitcoin, so that means by stacking just $20 a week for about 5 years, we've stacked more than a tenth of a Bitcoin, 0.12159,987 Bitcoin to be exact. Now, I remind you If Bitcoin were to be equally distributed amongst every person on Earth, something that's impossible based on the fact that some Bitcoin's lost, Satoshi has 1 million Bitcoin. For now, Michael Saylor has 840 some odd thousand Bitcoin, etc. But theoretically, if you could take all 21 million Bitcoin and spread it out evenly amongst the global population, there are less than 250,000 Satoshis per person when hyper-Bitcoinization comes. And right now, just stacking $20 a week, we have more than 12 million. So putting us significantly better off than the average person will ever hope to be. And of course, if you're investing more than $20 a week, percentage-wise, you got the same gains that we have, but you're doing even better when it comes to the size of your stack. Of course, ignoring price and buying all the way up to the last cycle's all-time high and all the way down to the last cycle's low and all the way back up to this cycle's all-time high and all the way back down to where we are now, we've purchased for an average price of just $43,256.63, which is not too shabby considering that's $20,000 less than Bitcoin's current price, even with Bitcoin basically 50% off. So we've already made our stack. The nice thing about automating our purchase is that, our data is much more pristine because our stack is occurring not only once a week, but at exactly the same time every week. But it also means if I'm on the road fighting traffic and preventing my dog from eating my headrest, my Bitcoin stack goes off on time. Even if my podcast is going to be a day late or two, which it wasn't today, thank goodness. But Strike took care of the dirty work and also made that stack for free. If you do automate your stack with Strike like we do, they don't charge any fees for those automated purchases. Strike is not a sponsor of the podcast. Just like Matt Odell saying about his Citadel Dispatch podcast, we do not have any sponsors. From time to time, we've had those of you contribute value back to this podcast through the value for value method by Podcasting 2.0, by either streaming sats as you listen or by sending a boost. But we don't have any corporate sponsors and we don't shill any products. I just happen to like Strike. And I happen to like Jack Mallers. I think he does good things for the space. But most importantly, I like the fact that 100% of that $20 went to buying sats. When we were using a different app to purchase Bitcoin a couple of months ago, maybe a year ago now, they charged 2%. So 30 cents out of every purchase went into fees instead of Bitcoin. And when you're stacking just $20 a week, every Satoshi counts. And it's silly to stack fewer sats, right? So it's a double bonus. We're stacking 100% of our investment, and it happens seamlessly without me having to worry about making sure I make that purchase on time. So that purchase already happened about the time I started recording this podcast. At the time, Bitcoin was at $63,552.59, about exactly where the price was when I began this podcast. And that means our humble $20 purchased another 31,470 Satoshis. That might not seem like a lot, but when Bitcoin goes back to 100,000, which isn't even the all-time high, but just passing 100,000, that means that will have the US dollar fiat value of $31.47. And of course, one day it's conceivable to think that Bitcoin will hit dollar Satoshi parity. And then we'd be talking about $31,470 for the Bitcoin for just $20. But the one thing I can tell you for sure is that 31,470 Satoshis increased our stack to where our stack is now sitting at 12,191,457 Satoshis. It did, however, raise our average purchase price because obviously $64,000, $63,000 is more than 43, but it only increased it by $52.39. So our average purchase price, our average cost basis, remains an incredibly respectable $43,309.02. Perhaps more importantly, for those of you who still live on a fiat basis, you're not valuing your day-to-day purchases in Satoshis yet, well, when Bitcoin does reclaim that $100,000 mark, our humble stack will have a fiat value of $12,191.45. Not too shabby at all, considering we've now converted $5,280 into Bitcoin. Of course, when Bitcoin hits that $1 million mark, which I firmly believe it will, our humble stack will be worth $121,914.57. And of course, Adam Back, who's mentioned in the white paper and been controversial depending on what side of the BIP 110 debate you were on. Well, back in 2022, he made his Bitcoin prediction that by the 2032 halving, or after the 2032 halving, one Bitcoin would be worth more than $10 million. Well, if and when his prediction comes true, our humble stack will be worth $1,219,145.70. But who can forget Fidelity's prediction that one day, or in fact by the year 2038, one Bitcoin will be worth $1 billion? That might seem pie in the sky, but there was a day when $10,000 seemed like there's just no way. Well, $1,000 seemed like there's no way. I mean, when Bitcoin is less than $1. And now we've seen Bitcoin as high as 126,000, which means Bitcoin is less than a 10x. So conceivable that if Bitcoin achieves its goal of hyper-Bitcoinization, that eventually one Bitcoin will be worth $1 billion. And when that happens, plebs, we're talking generational wealth. Our humble stack, and hopefully yours is larger if you're stacking more than $20 a week, but our humble stack will be worth $121,914,570 US. Again, not too shabby considering that we've been stacking just $20 a week and stacked a total of $5,280 now. I just noticed that I'm sitting in a place that's exactly a mile high, and a mile is 5,280 feet, when we've stacked $5,280. So that's kind of serendipitous. All right, I promised I needed to keep this one tight, and I have managed to pull that off. So we're going to end this episode a little bit sooner than usual. I apologize if you're looking for a solid hour rip. The next couple episodes will be a little different because, like I said, I am on the road. But I will be back, next Wednesday, one way or another, to keep stacking those sats, to keep talking about the latest news, to keep pumping you hopium, to keep trying to give you as bullish and optimistic take as possible. And of course, we'll continue growing that stack as long as there's still people out there foolish enough to trade us Satoshis for worthless paper money. Until then, though, keep on stacking those sats, you sexy sat stackers.